3, 2, 1.
Dun-dun. All right. What day is today? There we go. That was a slide. 3 December 2023. It is December already.
Yeah, I didn't even know when I woke up this morning. Friday, we're recording it. It was the December 1st. I was like,
yeah.
It scared me.
No, today's December 1st, so we got 2 new reallocations for the month. And
Starting fresh.
Yep. We shall see how it goes. This has to be the most hated bull market. A lot of people are talking about that. A lot of people got caught on the wrong side of it at the beginning of November, and anybody that you look at on the technical analysis side on YouTube or wherever you get your news, the market's gone straight up for now over a month. It doesn't mean it has to roll over. It certainly has to consolidate, but it's pretty remarkable what's going on. The newsletter this weekend is kind of going into the dollar and yield and where they are relative to where we think the market should go next. But I mean, it's the indicators are all screaming that we need a pullback.
Yeah.
But until
it
begins, you don't know. So we shall see. All right, TSP Weekly Podcast, 3 December 2023. So we'll talk about some of the events happening this week, housing, and why that matters as far as the direction that the market could go. And the forecasts for 2024 are starting to roll in. We'll take a look at a couple of them. And then daily and weekly C-Fund chart. And then I have one extra chart at the end. Okay. So this week, it feels like Thanksgiving was a long time ago, but honestly, this was the first week back in the office for Wall Street. Kind of a sad week. Charlie Munger, who was Warren Buffett's longtime business partner, he died. He was 99 years old. And then Henry Kissinger dies, interestingly enough, that we're firing up a new Middle East war and not going to have his input for that. Salesforce, Dollar Tree, and Hormel Foods all came out with earnings like Wednesday, Thursday. Those are 3 kind of core companies that you can look at for the overall assessment of the market. Salesforce, obviously huge in tech. Dollar Tree is kind of lower end retail, and Hormel Foods. Salesforce is up like 11-12% since earnings came out on Wednesday. Dollar Tree was up like 5%, and Hormel was down like 5%. So interesting to see what the rotation, what kind of rotation is happening. And then new home sales and other data, we're going to take a look at that in a second. And then Fed speakers were out all week, and of course they are always the Fed governors get to come out and do their different take of what they think should happen, and then they go into the next FOMC meeting, and then they all line up like good soldiers behind the chairman. So I don't know why Bloomberg makes such a big deal of the governors speaking in between the FOMC meetings, because they rally behind the chairman every so. And we get the next Fed meeting next week. It's early December, so that'll be interesting. Not that I think it matters much, because yields are already coming down, and the Fed hasn't lowered rates. So obviously, the Fed is chasing the market, not the market responding to the Fed. Okay, so a pretty interesting one here from CNBC. The economy grew at an even stronger pace than previously indicated in the third quarter. So the product of a better than expected business environment, strong government spending, which is an important one, strong government spending, commerce reported. So this is an update to the one from the beginning of the month. GDP as a measure of overall goods and services produced during the 3-month period accelerated at a 5.2 annualized pace. So the GDP that came out earlier was 4.9, and so the second run at the numbers was 5.2, but that was still better than the 5% forecast. So GDP is going in the right direction if you want to see the economy getting stronger. Preliminary, the upward revision came from increases in non-residential fixed income, fixed investment, so includes structures, equipment, and intellectual property. Category showed an increase of 1.3%, which is a downshift from previous quarters. It kills me how they talk about it's an increase, and then comma which is still a sharp drawdown from previous quarters. So the spin, and you have to really think about it to get past the spin. But what kind of grabbed me about this one was these two. Government spending also boost in the third quarter, rising 5.5%. So when the government spends money, it looks like the GDP goes up, but the government doesn't make a product. There's no gross domestic product from government spending. It gets reflected in the number, but the reality is there's no production happening for that amount of money that goes into the economy. And so the numbers look better, but it would be a whole lot better if government spending decreased and GDP went up. That's a way better place. And then, however, consumer spending saw a drawdown revision, now rising just 3.6 compared to 4% in the initial estimate. So the revisions are pretty important because they're always talking about how the consumer's still, spending more, and downward revisions in consumer spending, don't make headlines, but they're kind of important because obviously the overall economy isn't as strong as they at least put out on the initial numbers this month. There was some mixed news on the inflation front. Personal consumption expenditures, PCE, a gauge the Fed follows closely, increased 2.8%, a tenth of a percent on the downward revision. So inflation is still a problem, but I don't know. I'm really, really curious to see what the numbers are after like the sales after Christmas, like after New Year's. They always have like big sales and everything. It'll be interesting to see how all that falls out, because apparently Black Friday did really well. Okay, so housing and why that matters. So a Bloomberg article, and this is really, it's interesting. Housing market mystery haunts Wall Street's 24 forecasts. Okay. The Fed, still very confusing to the Fed. So try to understand this. Yesterday we got a data that showed median new home prices plummeted 18% year over year. Okay, that was like on Tuesday. And then on Wednesday, a national gauge of existing home prices rose for an 8th straight month, surging to a new record high. So yesterday we get median home prices plummet 18%. And the next day we get home prices rise for an 8th straight month. Like how, so are they rising or are they falling? Right? This is Bloomberg asking the question in this article. It's kind of unbelievable. So it's a bit of mind spinning, right? The dynamic in the housing market, that's one that's still very confusing to the Fed. Housing market has been one of the least understood aspects of this phase of the economic cycle. Everyone expected home prices to fall when mortgage rates shot up to 8%, right? That makes sense. When rates go up, price should come down because the amount that you can pay every month pretty much stays fixed, unless you get a raise or cost of living adjustment or whatever. Turns out most American homeowners had locked in record low rates and had no intention of giving that up, meaning no one was selling. And so the lack of inventory, because at the end of the day, it's supply and demand, right? The lack of inventory has led to bidding wars and higher prices for existing homes. So the lack of inventory is overshadowing the normal economic process of when rates go up, prices come down. And so builders, meanwhile, have been trying to fill the gap with new construction. Market for new home sales has been a different dynamic altogether. Fitting those pieces together into the same picture as Wall Street's 2024 forecast and the Federal Reserve is tricky, to say the least. And yet, housing looms so large. So why do we care about housing with respect to TSP? It's critical. The housing component is about 40% of core CPI and 30% of core PCE. So consumer price index and PCE, I'm drawing a blank. But they're the two big core pieces of inflation. And so if housing prices are still going up because inventory is low, then that piece of the inflation number keeps going up, and it's 40%. So for the Fed to get down to its 2% target, while housing is still going up, which is 40% of the number. It's going to be really hard for the Fed to hit its overall 2% inflation number.
Right.
And so you get the bond market that clearly yields are coming down, but so it's going to be really interesting to see in December, does the Fed hold, which I think is most likely, come down and try to get more in line with what the bond market is already doing, or raise because inflation isn't coming down to the 2% target that they want.
Yeah. I mean, there's no crystal ball, but I see hold fast to see what happens more. Going up and down would up or down would really rattle folks one way or the other, because you're usually on one side of this argument as to whether it should be going up or whether they should go down.
Yeah.
And holding out a little bit longer probably would be the smartest move. But the PCI, personal expenditure.
PCE, personal consumption expenditure. Yeah. It's interesting because oil prices are tanking, right? They've been tanking for a while. Gas prices are coming down. So all that says that inflation is coming down. But housing at 40% of the number, so you can look at it and say, all these inflation's coming down in all these areas.
Mm-hmm.
And that's true. But if it doesn't come down in housing, which is 40%,
that has a huge impact.
Right. How do you get down to that 2% number?
Yeah.
So
the housing thing is just such a conundrum, right? It's just around here, we live in one of the craziest housing markets in the country because it's one of the wealthiest two counties in America, Fairfax County and Loudoun County in Northern Virginia. Yeah. And then you've got all these houses that are exploding in just a year ago, 2 years ago, you could get a townhouse and people that are listening to this live in other parts of the country are probably going to pass out. But you could get one for like $500,000, $550,000. And right now, just last night I looked around, and the average townhouse / condo, the ones that kind of look like a townhouse but they're really a condo, they're pushing $700,000.
Yeah, at 7.5% to 8% mortgage rates.
And I'm like, and that's the only options because, as you pointed out in the article, nothing's for sale.
Right.
And anything that's not for sale, you got a lot of folks out there like, man, if I sold my house right now, I get twice what I paid for it.
Yep.
But where are you going to go? Where are
yep.
you going to go? Because you're just going to drop down and buy a $700,000 townhouse,
at 3 times the rate that you had your other house for.
If you're in certain areas and you're selling and moving away, that's about the best option you have. Yeah. But if you're in a place like we are, that's going up, faster than the rest of the market.
Yeah.
You got to go once you sell,
I was listening to Bloomberg the other day, and there was this young host or reporter on there. She was talking about she's looking for an apartment, a 1-bedroom apartment in the Upper East Side of Manhattan. And she's been hunting around for a while, and they were talking about it was a real estate segment, and she just kind of did her personal experience of it, right? She had made 5 offers, and they all fell through for whatever reason. They were all between $1 million and 1.3 for a 1-bedroom apartment.
Oh my gosh! New York's always been crazy, but that's freaking nuts.
Yeah, and the rates didn't matter because she's like, everybody comes to the table with cash. If you to the point where you come to the table with cash, it used to be a big deal. Like that would get you over the.
Nope.
It doesn't matter anymore because everybody does, and so. She's like, and the question from the other host was like, so, if you don't have the cash and you go to the bank, are banks even lending now? And they are lending, but again, nobody wants to pay that 8% rate.
Yeah.
I don't know how people are doing it. I feel bad for my kids, to be honest. If you're trying to buy a house and you're, 25 to 30,
it's a tough time.
It is rough. All right. So yeah, it affects us in terms of TSP because if rates don't come down, it's the whole higher for longer thing increases the odds that something breaks. It decreases the soft landing potential is the idea. Okay, so we got a couple of expert forecasts, right? Expert in quotes or whatever. Here's one from MarketWatch. S&P may sink as low as 3,100 next year. It sure could. Then again, it could be 6,000 next year. Who knows? S&P will soon wrap up its best month in more than a year. Even a limp to that finish. So this was just before the end of November. This article was seems to be playing out, won't move that needle very much, right? One particularly frustrating aspect of 23 for investors has been waiting for a recession that never came, as many Wall Street banks also bet on that happening. BCA Research, who provides our call of the day, also expected a pullback and says now inevitable in 2024, possibly crushing stocks by 27% from current levels. I don't know how they come up with 27%, but they say it's inevitable, and whenever they say it's inevitable, I don't want to be on the same side of the trade. We do not expect any further rate hikes in the U.S. over the coming year unless inflation significantly picks up. However, investors are pricing in too much easing before a recession arrives and too little once it does. So stocks are likely to decline significantly in response to a recession. That makes sense. Leaving the S&P trading between 3,300 and 3,700 next year. Okay, so that's what BCA strategists think as their forecast for next year, 3,300 to 3,700 by the end of the year. And this was really the big takeaway from this. Investors can also forget about the easy money that drove assets between 2009 and 2021. This is the thing. Between 2009 and 2021, rates were basically at 0.5% for almost that entire time, so money was super cheap, and we're not going to be in that environment anymore, and that's what the market is trying to figure out. So neither a prolonged zero interest rate policy nor the sustained use of quantitative easing as a monetary tool are likely to emerge during the next recession. That's what the Fed always does. When we have a recession, they lower rates, and they start doing quantitative easing. Interest rates are likely to be considerably higher on average over the next decade than they have been over the past decade. And we've shown a bunch of charts about that. If you look at a chart of the 10-year yield, it's declined for the past 40 years to a low in 2020, and it's been going up ever since, which is why mortgage rates are high and everything else. So how to prepare for all the above in combination with a meaningful decline in long maturity government bond yields, right? So that's a decline in yield means an increase in price of the bond funds, which is why we're always talking about the F fund. So a meaningful decline in long maturity government bond yields means the F fund goes up. A recessionary scenario would imply a very substantial decline in the U.S. stock to bond ratio. The language is kind of goofy, but which would justify an underweight stance toward equities within a global multi-asset portfolio. What they're saying is they're expecting investors to go much more heavily into bonds and less in stocks. They say growth stocks will help drive outperformance for U.S. equities, but they can't justify an active overweight position in an index that is so driven by a narrow group of names, the Magnificent Seven tech dream team. So these guys are not buying into the sustained continued move higher in the Magnificent Seven, and so they're not getting into the index. So note, BCA seems to be standing out with its bearish views. Deutsche Bank, Bank of America, and RBC are among a list of Wall Street banks predicting S&P at 5,000 or higher to end next year. So this note is interesting because it's saying that the article that we just went through, BCA, seems to be standing out with its bearish views, and they're using the opposing views from Deutsche Bank, Bank of America, and RBC as bullish. And that's only at 5,000. I mean, we're almost at 5,000 now. We're 4,600 pretty much right now. So by the end of next year, the bullish calls are at 5,000. So even the best case doesn't look great for next year. And then Wells Fargo comes out and warns of a really, really sloppy first half for stocks. So Chris Harvey, the firm's head of equity strategy, sees a volatile path to the S&P 500 for 46.25 by the end of next year. Right, 46.25 by the end of next year. We are pretty much at that right now. It's really hard to get excited. If we have better economic growth, then the Fed doesn't do anything. If we have worse growth, then numbers are going to come down, and the Fed will eventually cut. Right, this is all the stuff we've been talking about for a long time. If we get a hard landing, if something happens in the economy, then the Fed has to cut. That's what he's saying. The second half will be better, but the first half is going to be really, really sloppy. Harvey's target is just 75 points above Monday's S&P close. So can we go higher from here? Sure. We can go a little bit higher, but I don't think we can get a ton higher. People have talked about 5,000. I don't see how you get to that level. His official 24 outlook, Harvey told clients to brace for a trader's market instead of a buy and hold situation. His earlier strategy, start with risk aversion. As long as the cost of capital stays high, which means rates stay high, it's really hard for me to get to a much higher price target. Yet he still sees opportunities for investors, and he's the equity guy, right? He's not the bond guy. He's the equity guy. What we want to do is we want to go to places that are oversold. We just upgraded utilities, healthcare. They're both two sectors of the market that are oversold. Those are good areas that have good valuation, decent fundamentals, and most people aren't really there at this point. And he says, I hate to say that being the head of equity strategies, right? He's not a bond guy, but he sees treasuries as an option, again, which is why we keep talking about the F fund. If you look at the alternatives, there are things that are pretty attractive. And I hate to say that as being head of equity, but you can park money at the front end of the curve and make a pretty good rate of return and not put on a whole lot of risk. Okay, what does this mean? You can park money at the front of the curve. That's like Fed funds rate up to like 2-year bonds. Those are what are impacted the most by the Fed, and they are the G fund for us. You can park money at the front end of the curve, translate that into TSP as you can buy into the G fund, and you get a pretty good rate of return. And when he says not put on a whole lot of risk, we put on zero risk. So the G fund is definitely not a bad place to be. Now, if the Fed lowers rates, that is directly lowering the rate of return of the G fund. But still for us, zero risk. And his 2023 S&P target is 4420, which implies a 3% drop from Monday's close. And over the course of this week, the market has gone up more. So he's calling for 4420 by the end of this year, which means he thinks December is going to be a rough month. Okay, I'm sure we'll get some bullish forecasts going forward, and I'll throw them up there as we do over the course of the next month. There's going to be plenty of people talking about Santa Claus rally. It's the last 5 days of December and the first 2 trading days of next year. So when we get there, we'll talk about that some more. Okay, C Fund. So we put up a chart, kind of. This is basically an updated chart to the one we did last week, but it's getting, I think, pretty important. I mean, we'll see. This is the relative strength index, and this is a weekly chart of the S&P. So back here at the end of 2021, relative strength topped out. Price put in a top, but it wasn't the final top, right? Price continues higher. Relative strength declines. This is the divergence that we're always talking about. The divergence between relative strength and price is a huge, huge indicator. And if it's on a weekly chart, it's a lot more valuable to us than when it's on a daily chart. So if we fast forward to where we are right now, we put in a peak in RSI, which was the top in July. We get a big pullback in price. We get a big pullback in relative strength. And then price is back up almost exactly to where it was, that 4,600 level. But relative strength is nowhere near back to where it was. Okay? So an even more bearish setup would be if price keeps going up, but relative strength starts rolling over. And we get more of a divergence this way. At some point, it goes down from there. There are basically no examples of having divergence between price and RSI and having price keep going higher and then somehow RSI catches back up. It doesn't work that way. So this may not be the actual top. It can still keep going a little bit. And it's possible that RSI does keep going with price at this point because it hasn't rolled over. And it's possible that we get some kind of pullback, say to this moving average line. RSI comes down to 50, gets support there, turns back up, and price keeps going. I mean, all these things are possible, but the setup right now is bearish.
Right. There's a lot of risk right now.
Yeah.
And you just have to decide if you're sitting in this position. Let's say you're in, right? You're in the market in your TSP. How much risk are you willing to tolerate? Right. And so you're coming into Christmas, you're coming into, you're in the holidays, all the things that are going on in your world. If you think to yourself, I don't want to be watching this on a daily basis, I don't want to be stressing over it. There is nothing wrong with just parking it in G, and you're now you're going to have to accept whatever way the market goes. You made that decision. If the market continues to go up and you're like, oh, I missed out on, you can't stress over that. Because you just put yourself in G to stop stressing about it.
Right.
So put it in G, be happy, and move on. Or if you feel like, no, this is my retirement account, it's important, I got to pay attention to it. Okay, fine, do that. Either way, if you are in, you got to be on it right now, because a day or two off of ignoring it could crush all the gains you just got.
Yeah.
Right.
Yep.
So, getting that trading, if you see these things turn over, and if you're one of the members on our site, we're going to be telling you if all these things turn over, right? That's part of what the members get. But if you're not, and you're doing this on your own, you got to be watching that. When these things roll over, you can't ignore it and just sit there and go, oh no, it'll turn back up. I hope. Nope, don't hope. Don't hope.
I mean,
because everything here on that chart is not giving you hope that it will turn over. So the risk right now is just, do you have the 20-day moving average up there?
This is the 20 weeks, so let's go to the next one actually.
Yeah.
So this is the daily S&P.
Yeah.
Okay. So here's the thing.
A lot of room to go down.
Yeah, I mean you're at a double top. Okay. You're 2 or 3% above that 20-day moving average line. So you're overextended to the upside, and relative strength has been overbought for 2 weeks at least.
Yeah.
So if like you just said, if you're looking at it on a daily basis, when RSI breaks down through that orange, that orange line is the moving average of the RSI. When that breaks down,
there's just not much reason to stay in.
Yeah, this is
and
a
you
lot
don't
of risk
want to
now.
sit there and wait for it to come all the way back down.
No,
you don't want to lose that 3%.
You could easily, the market could open down here.
Yeah.
And take out
in a day
all those gains in a day.
Yeah.
No problem.
Yeah.
So the last one I wanted to look at, this is the S fund daily. And I just wanted to kind of point this out. So what I basically did was go back and I just used relative strength. And all I did was when relative strength got overbought, okay, relative strength gets overbought, and when it rolls over and closes below the orange line, like I was just talking about. Okay. It only happened 5 times. Okay. Here's where we are right now. So it's still moving higher. It's at 69.22. So it's basically right at that 70 level. It hasn't rolled over. It can still go higher, but it's much closer to at least a short-term top than a short-term bottom, right? So at least going back to November 2021, when it got overbought and then closed below the moving average of the RSI line, it began this big decline. Same thing here. That was the exact top, began a big decline. Same thing here. This one is the one that kind of gives you pause, because it doesn't, this doesn't work 100% of the time, right? So on this one, we had a peak in price. We got overbought in RSI. We came down through that moving average of the RSI line. But then RSI got support at 50 and moved back up, right? Only moved up for a couple of weeks, and then, it rolled over again. But could that happen this time? Could you get a pullback? RSI pulls back to the 50, you get a little pullback in price, maybe even it fills in that gap, and then keeps moving higher. You don't always have to get these big declines, right? You can get a pullback, get some support, and then it keeps going higher. So nobody has a crystal ball. So we're trying to avoid these things. And the way you do it is to get out when the risk is the highest. And the risk is definitely highest when price rolls over and RSI breaks through that moving average line. Once that happens, then you're looking for the next place to get back in. Hopefully that makes sense. No guarantees, but you can see the setup. Okay. That is pretty much what I got. If you guys are looking for more in-depth stuff, the newsletter this weekend is going to be mostly about yield and the dollar, because they are both what's driving the train. Questions.
As always, if you have questions, put them in the comment section wherever you found the video. If you found it on Facebooks and YouTubes and all the things.
Places.
If there's no comment section, feel free to hit us up at support@growmytsp.com. The support team will get the question over to us. We love questions. We love comments, because a lot of times they make it into the show as a topic to talk about, right? So don't hesitate to reach out to us. And if you like the show, please share it with your friends. If you don't,
share it with everybody.
Share it anyway. Hope you guys have a great week, and we will see you soon.